Okay, so you want to own an apartment building. Not a single apartment, not a house. An entire building filled with tenants, leases, and monthly rent payments. Picture it. 20 units, 20 front doors, and rent arriving every month like clockwork. At $2,000 per apartment, that's $40,000 a month. Nearly $500,000 a year. From the outside, it looks like you've built a machine that prints money while you sleep. But that's where the fantasy ends, because that $480,000 isn't your income. It's the building's revenue. And the building has a long list of people waiting to get paid first. The government wants property taxes. The insurance company wants its premium. The roof eventually wants replacing. The plumbing will eventually betray you. Tenants move out. Apartments sit empty. And someone has to keep the entire machine running. Then comes the biggest bill of all, the mortgage. Imagine paying $4 million for the property and financing most of it. Suddenly, hundreds of thousands of dollars can leave your bank account every year before you've taken home a single dollar. And here's the uncomfortable part. You can own a multi-million-dollar building, collect nearly $500,000 in annual rent, and still lose money. Because apartment ownership isn't really a rent-collecting business. It's a spread business. What the property earns versus what it costs to operate and finance. That's where the fortune is made. And that's also where it can disappear. Because one vacant apartment is a nuisance. 10 can become a problem. And with enough debt, a bad year can put the entire building at risk. So what are you actually buying when you buy an apartment building? An apartment building isn't one business. It's 4 completely different businesses hiding under the same roof. Start with a duplex or 4-unit property. Maybe it costs $600,000, maybe $1 million. The market decides. The revenue is relatively small, but the operation is simple enough that the owner can still know every tenant, answer every call, and sometimes fix the problem personally. Then the scale changes. A 20-unit building charging $2,000 per apartment produces $40,000 a month in scheduled rent. That's $480,000 a year. Now you're not just collecting rent, you're running a company. Vacancies become expensive. Repairs become constant. Management becomes a real expense. And every month, the building has to perform. Then you reach 50 or 100 units. Now the property can be worth millions, with potentially millions in annual rental revenue. But here's the trap. Revenue doesn't scale alone. Neither do the problems. More apartments mean more tenants, more turnover, more plumbing, more roofs, more insurance, and more money tied up in debt. Then come the institutional properties with hundreds of units. At that level, you're no longer playing landlord. You're operating an asset with professional managers, lenders, investors, maintenance teams, and millions of dollars riding on occupancy. And this is where apartment economics gets fascinating. Scale can make each unit cheaper to operate, but it also makes mistakes exponentially more expensive. A small building can hurt your wallet. A large building can threaten your entire balance sheet. Because when you multiply the apartments, you don't just multiply the rent, you multiply the machine behind it. The purchase price is only the beginning. The moment you get the keys, the meter starts running. Take a $4 million, 20-unit apartment building, put 25% down, and you've already committed $1 million before collecting your first dollar of rent. The remaining $3 million becomes debt. At 7% interest, that's roughly $210,000 a year in interest alone. And that's just the beginning. Property taxes take their cut. Insurance takes another. Then the building starts asking for money. A pipe bursts. An HVAC system dies. The roof needs replacing. The elevator breaks at exactly the wrong time. None of these expenses care whether your tenants paid on time. Then there's property management, utilities, landscaping, legal fees, accounting, inspections, and compliance. And vacancy quietly attacks the revenue from the other side. 2 empty apartments at $2,000 a month don't sound catastrophic, until you realize that's $48,000 a year that simply vanishes. No tenant, no rent, still paying the mortgage. This is why a $4 million building isn't really a $4 million investment. It's a $4 million asset attached to a much larger financial machine. Debt determines how much cash leaves. Operating expenses determine how much survives. And unexpected repairs can destroy the margin you thought was protecting you. The building may look like the investment, but the real investment is the cash flow underneath it. Because owning the property is easy. Keeping enough money flowing through it to survive every bad month, that's the business. So where does the money actually come from? Not from the rent. From the gap between what the building collects and what it manages to keep. Take that 20-unit building again. 20 apartments at $2,000 a month. That's $40,000 in scheduled rent. Sounds fantastic. Now watch the money disappear. Vacancies and unpaid rent take $2,000. Maintenance, property management, insurance, taxes, utilities, and other operating expenses consume another $15,000. That leaves roughly $23,000. Then the bank arrives. Suppose the mortgage costs another $19,000 a month. Suddenly, the building collecting $40,000 every month is producing only about $4,000 in monthly cash flow. That's $48,000 a year. And that is the number that matters, because revenue gets attention, cash flow pays the owner. But here's where the serious operators start playing a different game. They don't ask, how do I collect more rent? They ask, how do I make every dollar of this building work harder? Raise occupancy, reduce unnecessary expenses, upgrade units where higher rent actually justifies the investment, renegotiate contracts, improve tenant retention, and, when the numbers make sense, restructure expensive debt. Because a small improvement multiplied across dozens or hundreds of apartments can become enormous. And here's the beautiful part. If you increase the building's income without increasing expenses by the same amount, you haven't just created more cash flow. You've potentially increased the property's value. That's the hidden engine. The real fortune isn't sitting inside the apartments. It's hiding inside the spread. This is where apartment ownership gets dangerous. Because a building doesn't have to stop making money to start destroying its owner. It only has to make less than the debt requires. Imagine a 100-unit property bought with aggressive financing. At 95% occupancy, the numbers look beautiful. Rent comes in, expenses get paid, the mortgage gets covered, investors collect their return. Then the market turns, occupancy falls, rent growth slows, insurance premiums jump, repairs get more expensive, and suddenly the building is producing less cash. But the lender hasn't lowered the payment. That's the trap of leverage. Debt can magnify your returns when everything goes right. When things go wrong, it magnifies the damage. We saw this pressure across commercial real estate after interest rates surged. Properties financed when money was cheap suddenly faced a very different reality when those loans came due. A building that worked perfectly at one interest rate could become painfully expensive at another. Imagine your property generates $1 million a year after operating expenses. Then refinancing increases annual debt payments by $300,000. Your building didn't suddenly become worthless, but $300,000 of your cash flow just disappeared. Now add higher vacancy, or a major repair, or another jump in insurance. The margin can vanish frighteningly fast. And that's how an owner can look wealthy on paper while running out of cash in reality. The building still has tenants. It still collects rent. It may still be worth millions, but the bills arrive every month. And the brutal lesson is simple. Real estate doesn't have to lose its value to break you. It just has to stop producing enough cash to satisfy the debt. So, after all that, is owning an apartment building actually worth it? Let's put the fantasy through the numbers. Take a 20-unit building priced at $4 million. You put $1 million down and borrow the remaining $3 million. In a strong year, the apartments average $2,000 a month with high occupancy. That's roughly $480,000 in scheduled annual rent. Sounds enormous. Until the building starts taking its share. Vacancies, maintenance, management, insurance, taxes, and other operating costs could consume roughly $200,000. That leaves about $280,000 before debt. Then the bank gets paid. Suppose annual debt service is around $240,000. Your cash flow is now roughly $40,000. On $1 million of equity, that's only about a 4% cash return. Not exactly the passive income fantasy people imagine. Now change the environment. Occupancy falls, rent growth stalls, insurance jumps, a major repair arrives. Operating income slips toward $220,000, while the debt payment stays near $240,000. Suddenly, you're losing about $20,000 a year. Same building, same mortgage, completely different economics. But here's what makes real estate powerful. The owner isn't relying only on rent. Tenants are gradually paying down the loan. The property may appreciate over time, and improvements that increase income can potentially increase the building's value. That's why experienced owners obsessed over margins. They aren't simply buying apartments. They're buying enough financial breathing room to survive bad years. Because leverage can turn a good property into a fortune or turn a small mistake into a crisis. So yes, apartment buildings can create serious wealth, but the building itself doesn't make you rich. The fortune lives in the spread between what the property earns and what it costs to own.